Welcome to Women Spring. I'm your host, Amy Aish, and today I have Sherry Williams, financial advisor. She's going to talk to us about what we need to know before investing. Welcome to the show.
Thank you for having me, Emmy.
I wanted to ask you about the young professionals, the younger generation. When should they start saving for retirement?
Well, younger generation, millennials I call them, they should start as soon as possible. A lot of them are fearful after finishing college or just out of high school saying they're not making enough, but it's never too soon to start. A lot of employers offer retirement savings plans, and some often think, well, I'm too young to retire. I have 20, 30, 40 years, but compounding is a great factor that helps people save more and more the younger you start.
How much should they save, to start?
Well, first they should consider what they can afford, depending on if the employer offers an incentive, like maybe 6% towards a match of whatever they're able to save, they should definitely take advantage of that.
Okay, now they decide to invest and save for retirement. What should they invest in if they are doing it on their own?
Well, I mean, doing research is a good idea on a wide variety of stocks. There are bonds that are offered, and then also, maybe starting opportunities in investing in real estate.
Investing in real estate. Why did you choose real estate in particular?
Well, it's considered in the financial world an alternative asset class, and it often enables people to save on a long-term basis because they are earning interest or growing equity in their property when they buy it. And usually they don't sell until they're ready to move to the next property, which they still have started to build up equity in their property for the next property.
Besides real estate, what other asset category do you recommend?
Stocks. So the younger you are, most young people, or millennials in particular, are not risk averse, and that's basically a term used in not being afraid to invest in things that have the ability to actually go one way or the other, meaning they could increase in value or decrease in value, because you can actually recover from that because you have a longer time frame or time horizon to make adjustments or readjust or increase.
Recover from a loss?
Yes, recover from losses.
One of the things like trading online, or what do you recommend? Like hiring a professional to do it for you, or you can do it on your own? What do you recommend?
So I am a financial empowerment coach, and I have an organization called Knowledge is the Power Foundation. I'm a former financial advisor with Morgan Stanley. I have a background in real estate and a background in insurance sales. So insurance is another product that people can invest in. They think that, insurance is for just when I die, but insurance policy also enables you to save for retirement as well. Now, as far as utilizing some sort of assistance in through financial advisor, empowerment coach, or anything of that nature, people can invest on their own by doing research.
How can they invest in insurance? Insurance meant to be for, when I go, my children will take the policy amount and do something with it.
So with insurance policies, there's basically four kinds. One is term insurance. So term insurance basically does not build a cash value. It's for a specified period of time. Whole life is a policy that actually accumulates in cash value. So every time you're depositing a premium or making a payment towards your policy, a portion of it goes towards a little account that grows in value because the insurance company is investing those monies to grow in value or assess or get earn interest for the customer or the client.
So if my kids are like graduate from college and I'm no longer worried what they will do after I go, I can use this money myself?
Yes, you can. With a whole life or not a term. Term, like I said, is for a specified period of time. You can get it for up to 10 years or even longer, but it does not accrue any cash value. That is basically, there's a cash benefit or a survivor's benefit when the person who has the policy passes away for their beneficiaries.
And I can borrow against this money?
Yeah, for the whole life or level or any of these other type insurance products or insurance policies, you can, but not term. Term is the only one that you cannot borrow against.
Let's talk again about investing. Before the companies goes public.
Yes.
This is when their stock value is the lowest. Am I right?
Well, so basically you're talking about in IPOs, initial public offerings. So when a company goes public, basically they start selling shares of their company, and you become, whoever purchases those shares become partial owners of the company percentage-wise. So before a company goes public, they're a private company and all the value of the company is for the owners. And when they go public, now they're opening up so that they can increase monies to be able to grow the business.
Because currently all the stocks, like most of the, the stocks that made money, it's very expensive. And for those young people to participate in, investing in stocks, it's pricey. So where is the best way to get in? Like real estate, certain areas like Clean, Vienna, or Northern Virginia is so expensive. Mm-hmm. So, but it was not like that 20 years ago. So,
absolutely.
And some areas are like very close to Northern Virginia. If you move to it, you might be able to buy a house at an affordable price.
Right.
How can we do the same thing with the stocks? Like the new companies that's going to be offered, public offering that you talk about?
So strategically, that's where financial advisors or financial empowerment coaches or someone involved in the financial services industry would come into play as far as that. As far as investing in IPOs, it's not as easily or commonly done for novices. You have to be following the company actually to know that, hey, on certain date, at a certain time, this company is going to go public, and I want to buy a certain amount of shares. Now, that's where a financial advisor who is in line or in tune with and has licensing to actually buy on your behalf, that's where they come into play, because they can, buy shares on your behalf as many as you want because they have the initial access, whereas someone on the street or a regular person that's not using a financial advisor wouldn't easily be able to access that.
When sometimes we see some stocks go down in value very much, mm-hmm. Do you recommend buying those type of stocks?
My personal belief is yes. You want to, the strategy is to buy low and sell high. That's how people make their profit in stocks. I'm a long-term investor, so the market is very volatile. It can go up one day and go down the other, but you have to think of the long term. And over time, stocks do gain their value and they recover from losses.
For somebody after 50, the government will allow you, or the tax code will allow you to invest, to shelter more money to invest towards retirement.
Absolutely.
How much more, should they be able to shelter?
So the federal government has implemented plans that have been long time in place. So if you as a young person resisted in saving for your retirement, at the age of 50, they give you an opportunity to basically catch up.
Okay.
And up until your retirement age of 66 or 67 or 70 or over. They give you maybe about 1.5%, not even 1.5%, about $1,000 or $1,500 more ability to the ceiling of the amount you can actually save in a savings account for retirement.
For a self-employed person, what will be ideal for their situation to shelter more money, like before tax? SEP IRA or self-employed IRA or solo 401k?
Well, they can do either. I'm a big proponent of Roth IRAs and IRAs in general because they're not necessarily always tied to a company. And as a self-employed individual, a Roth IRA offers you the opportunity to start investing or saving rather for your retirement, and they are already, the funds that you put in for the savings are already taxed. So you don't have to worry.
This is Roth IRA?
Yes, Roth
Okay.
IRAs. So at age 70 and a half, when after you've retired, that's the time that RMDs, required minimum deposits, have to come out of your savings account, your retirement plans.
So what about the solo 401k? What's the benefit for having that? I heard you can borrow money from your own retirement account and not be penalized, like versus self-employed IRA. If you take money out before certain age, what's the age limit for?
So with most retirement plans, 59 and a half is a specific age that the federal government says, hey, if you're saving for retirement, these are designated because of tax benefits, and you withdraw any amount of money from any of those accounts designated for your retirement, you will be penalized 10% minimum in addition to other fees and other taxes.
But if you go for a Roth IRA, it's already, the tax is already paid on the money you're investing, and you don't have to worry about that.
Yes.
What about?
But you will pay taxes on gains at any time.
Even if
on gains.
On gains, even Roth IRA will be taxes on gains.
Yes. Because anything that's an investment, whether it be an annuity, whether it be 401k, 403b, TSP, anything that goes in, taxes taken out prior to you investing, or taxes taken out after you've invested it, there's going to be taxation. But the principal amount that has been put in on, say, for instance, an annuity, that won't be taxed because that went in already taxed. But when you withdraw it, they do not tax the principal, but they tax the gains.
Okay,
yes.
The profit you made on your money.
Yes.
For somebody like got divorced or go through a difficult situation and they want to start, like they are in their 50s and they just want to start, what do you recommend for them to do to be able, like at the age of 70 or 65, to have a decent retirement saving?
Well, one thing that I'm sure a lot of Americans are not familiar about with reference to Social Security is that if you've been married for 10 years or more and you're now divorced, you may be entitled to your ex-spouse's, a portion of your ex-spouse's Social Security. So that's one source of income. But most Americans can't depend solely on their Social Security benefits. So it's definitely imperative that they start to think about retirement and how they're going to live, whether it be selling their home, whether it be investing in annuities, Roths, retirement, participating in company retirement plans. They definitely have to put some plan in place.
Okay. What do you recommend the current economy? Do you think the stock market gonna continue to do well, or like?
Yeah, it's been going strong for a long time. It's been the longest stretch in history for the financial markets doing so well. Analysts have said that they anticipate a downturn in the near future because everything can't stay the same ongoing. However, just being safe better than more than sorry is basically just balancing. I'm a big fan or proponent of diversification. So if you look at your portfolio or your savings and look at putting investments in different places or different asset classes. So if stocks start to tumble, then you have the safety of bonds to balance out, or you have the safety of whatever other investments you have that will balance out your portfolio.
For our audience to know, based on the age, at what age we should consider things that's low risk?
Basically, they say older adults, maybe baby boomers, the closer you are to retirement, you need to start leveling out and going a little bit more safer, in that bonds are one of the most safest asset classes, more so than stocks. But stocks have a little bit more risk because they're more volatile. So just balancing out your portfolio to have more of a percentage of bonds in there versus stocks.
So is there a way like to invest and protect your investment to stop the loss? If they go low to certain point, you tell your financial advisors to sell them, or like?
Well, that's the one thing about financial advisors, are supposed to keep you calm. You have to your financial advisor will assess what your risk tolerance is, and they have that personal relationship with you and understand what your goals are for future and long term. So they should basically come into place in that situation. When the market starts to tumble or tank, my best recommendation is not to just pull out, because it does have a tendency to rebound. So the housing crisis, the mortgage crisis in 2007, where we are now 2020, things have changed. A lot of people it has rebounded, and a lot of people are doing very, very well. The economy, jobs, all of the above. So nothing stays the same, but you also have to be prepared for the future.
Like after 50, how much, like what will be the appropriate amount to save?
So studies show
if you are making enough money, is there a formula? How much, like comparing to your income?
So with baby boomers in particular, studies have shown that they're not as prepared as they should be for retirement, particularly women. I focus in my nonprofit on women and in empowerment. In the next few years, or actually up to about 2035, there's going to be a higher percentage of baby boomers in retirement than anything, and they have shown studies that indicate a lot of retirees or pre-retirees are not planning enough or planning in advance for retirement. With women, they stand to inherit a great percentage of the wealth in the next coming years, and they actually outlive men. So they're more at risk. So women in their 50s preparing for retirement, if you didn't start younger, you still have an opportunity now, but just do not rely on Social Security.
How much should I save if I didn't save in the past? And now I'm 50, and how much should I set aside every month to be able to retire with dignity, save enough money for retirement?
So they basically say that you should have about 80% of your income in some kind of retirement savings of some sort to basically maintain the lifestyle that you need. But the biggest expense that people are unaware of in retirement is healthcare costs. Mm-hmm. So planning for that, incorporating maybe long-term care plans, which are also investments, insurance products that will help you for retirement. The biggest cost, again, for retirees in today's market is long-term care costs. So not having enough monies put away in the event of catastrophes or emergencies pertaining to health will be the biggest detriment to your financial savings for your retirement.
Speaking about insurance, if I want to get an insurance plan that can pay my salary if I retire and I lived longer and I run out of money. Is there such a policy exist, like to long-term care plan, you said?
Long-term care plan. So
what does it cover?
So long-term care basically covers costs associated with taking care of you in the event that you cannot perform one of the 7 ADLs, daily activities. So if you cannot go to the bathroom, if you cannot get up out of a chair, if you cannot feed yourself, anything of that nature, Medicare does not take care of those costs. So you have to have private savings that will pay for you to have someone to support you. 9 times out of 10 it's very, very difficult to utilize a family member for caregiving. They have to basically stop their lives in order to care for their loved ones. So having some plan in place with reference to that in the event that you need it. Seniors are living longer and longer, and the life expectancy is something from 83 or 84 for women in particular, and a little bit lower for men. So you may have, if you retire at 60, you may have additional 25 years to live. How are you going to live if you're not prepared with, as far as financially? Costs are going to go up, they're not going to go down.
Investing in foreign currency. So certain parts of the world are going through difficult time now and their currency is way down in value. Do you recommend investing in buying this type of currency?
So that's a specialized investment strategy. That would be best done through a financial advisor. And you're kind of touching on emerging markets as you talked about emerging markets. So it's been stated that in the next couple of years, a lot of countries, not necessarily third world, but developing countries, their economies are going to grow substantially. And in that, there's going to be a lot of investment opportunities. So thinking or doing research into specific countries based on what their imports or exports are, that would be a good idea if you're even considering investing in foreign currencies.
Okay. Finally, what do you recommend for somebody just starting, trying to do online trading and all of that stuff? Do you recommend them like going to school before they go for it, or like it's something I can teach myself, like go online or on YouTube or read a book? Like, what does it take?
So it does take initiative, I would say, in engaging someone who is familiar with the financial services industry, someone like myself who's an empowerment coach. So basically, you have to have the desire to learn. Basically, I help with people creating plans for the future, whether short-term or long-term, and executing those plans. So I kind of basically show them the path and then help them, guide them along the way until they achieve the goals that they've set for themselves.
Some financial advisors or investment companies, they charge fees monthly and annually. What's the difference in which one should I go for if I'm hiring one to invest for me or to manage my investment?
Okay, so depending on the company that they work for, they decide what type of fees they charge. Now that is still negotiable between you and your advisor.
Really?
Up to a certain percent.
I never heard it. Like they sent me the statement and I see fees every time I receive a statement that I didn't know this can be negotiated.
It can be negotiated up to a certain percent, because remember
up to what?
So it varies depending on the company and the services that you have basically gone into contract with the advisor or the company to render for you.
But all of them, I think, do the same thing, right? They buy stocks and sell them. Like, what else do they do?
Right. No, they can actually offer additional services. So a company that I formerly worked for, Morgan Stanley, they had a bank they also had another company or subsidiary, which was a bank. So their financial advisors could offer to their clients the opportunity to do banking as well. So it's not just like one opportunity per advisor or per company. So every company is different in that respect. They may have financial advisors under their umbrella or the wealth management division, but they can offer a multitude of other services. So that's why the fees are going to vary.
The fees going to vary, but it's negotiable, as you said, up to like 25%. I can negotiate. Like how much should I negotiate?
So that varies on the specific service that's being rendered to you by that advisor and or that company.
Thank you. Great information. Thank you for coming, and we appreciate all the help for millennials, and a lot of people like myself learned a lot from the information you give us. Great information. Thank you for watching.